Picture the actual moment. You move 6 figures into an account. You click Buy. The screen confirms the order in 2 seconds. Your heart rate drops because you think the hard part is over. You tell yourself you avoided stock picking, hype, and gambling. You did the responsible thing, but responsibility is not the same as precision. And in investing, tiny differences hide in boring places. A fee line you barely read, a fund structure you assume is interchangeable, a dividend stream you never compare, a platform choice you treat like a logo. None of that feels urgent on day one, but over time it becomes the bill. That is why this comparison matters more than most people realize. Not because Fidelity and Vanguard are risky, but the exact opposite. Now zoom out. We aren't talking about chasing a hot stock or timing a crash. We're talking about the part of investing people call boring. The part that is supposed to run on autopilot, S&P 500 funds. And yes, I know the standard defense. Fees are tiny now, so who cares? That sentence has probably cost ordinary investors more than flashy scams ever did. Not because the numbers look dramatic in 1 month, but because they don't. And this gets even more misleading because the words themselves sound interchangeable. Index fund, S&P 500, total market, passive investing. And here is the deeper irony about why index investing became so respected. It challenged the old illusion that expensive experts could consistently outsmart the market. After costs, that challenge was absolutely correct. So before the fund showdown, we need to look at the DNA of both firms. Because funds do not appear out of thin air. They're shaped by a company's culture, incentives, and philosophy. One firm built its reputation around innovation, scale, tools, and aggressive competition. Before anyone says it is only a tiny fee, stop and do the math. On a $100,000 investment, a 0.02% fee is $20. A 0.04% expense ratio is about $40 a year. That sounds harmless until you realize the market isn't compounding your full amount anymore. Every year, a slice gets removed before your money gets to keep working. And if you leave that money invested for decades, that small difference grows. Now look at the two firms through that lens, not through branding or loyalty. Just look at them through the cold arithmetic. Fidelity came into this fight, throwing punches on cost. Their S&P 500 index fund carries an expense ratio of 0.02%. Vanguard's version sits at 0.04%. On the same $100,000, that is roughly $20 versus $40 per year. In the source comparison, it was framed as about $15 versus $40. And that is only one layer of the problem. Vanguard also charges a $25 annual fee on brokerage and IRA accounts. Unless you go paperless or have over $5 million invested. Think about what that means in real life. For a normal investor, you open an IRA, fund it slowly, and check it once a month. Then you get hit with a $25 account fee. Unless you crossed a threshold that most people will never touch. Fidelity has no account fees, even on IRAs and smaller balances. Then the little frictions keep piling up. Vanguard charges $1 per options contract, while Fidelity charges 65 cents. On secondary market bond trades, both charge $1 per bond. But Fidelity's broker fee is $20 compared to Vanguard's $25. None of this is glamorous or exciting enough to brag about at dinner. But that is exactly why it matters. So if you only care about cost, this round is brutally simple. Fidelity wins. Lower fund expenses and no annual account maintenance charge. Cheaper trading extras mean less drag on every dollar you put to work. And when the starting amount is $100,000, less drag isn't a slogan. But cost is only half the trap. Saving $20 here and $25 there feels smart. Yet fees alone do not answer the bigger question. What happens when both funds are tied to the same engine of wealth creation? The S&P 500, where historical returns have averaged about 10% annually, and over the last 15 years have been closer to 12% per year. That is where this gets more interesting. If the fees are different, but the growth engine is nearly the same, then the real test is no longer marketing. It is what the underlying fund actually does with your money. Here is where the story gets uncomfortable for anyone still repeating the old line. The old line that hard work is what builds wealth. In markets, effort is not what gets paid, ownership gets paid. The person answering emails at midnight, driving to the office before sunrise, squeezing every dollar out of a paycheck is playing a completely different game, different from the person who quietly owns the underlying assets. When two funds hold almost the same slice of America, the real question is not who worked harder to earn the money. Take the S&P 500 matchup. On paper, these funds look so similar that most people would shrug. They would just shrug and say, it doesn't matter. Fidelity and Vanguard both follow the same giant companies. Same broad market exposure, same familiar names. If you glanced at the ticker symbols and moved on, you'd probably think this was just splitting hairs. But wealth isn't lost in dramatic explosions most of the time. It is shaved off in quiet places, in tiny performance gaps. Gaps that feel irrelevant in 1 year, but become a second mortgage over 30. That is the dividing line people miss. The financial system doesn't punish you only when you make an obviously bad choice. It also extracts from you when you treat close enough like a strategy. The worker mentality says, I'm invested, so I'm fine. The owner mentality asks, which structure keeps a larger share of the compounding? One person sees two nearly identical products, and it gets clearer when you zoom out from the 500 biggest companies. Zooming out to the total United States market. This is where the story of ownership becomes harder to ignore. Because now you're not just buying the skyline, you're buying the whole city. The giants, the mid-sized firms, the smaller companies trying to become tomorrow's giants. Fidelity's version is Feskax, and Vanguard's is Vitsax. Both spread your money across roughly 4,000 publicly traded companies. Look at the actual engine under the hood. Fidelity Feskax shows a forward dividend yield around 0.99%, dividend growth near 5.35%, and annual share price appreciation of about 12.05%. Vanguard Vitsax comes in stronger with a 1.16% yield, dividend growth around 5.82%, and 12.22% average share price appreciation. None of those differences look dramatic by themselves. They look harmless, boring even. So imagine two investors doing the exact same responsible thing. Same $100,000, same patience, same discipline not to panic. Same decision to reinvest dividends and leave the money alone for 30 years. This is what systemic wealth sorting looks like in the real world. Not some cartoon villain taking your money in one giant swipe. It happens through tiny structural differences most people are trained to ignore. And that smaller outcome is not abstract. It is a daughter's college bill that no longer feels comfortably covered. It is extra years before retirement stops feeling risky. It is the difference between withdrawing with confidence and staring at a spreadsheet at age 62, recalculating whether you need to work 2 or 3 more years. That is why the wealthy don't obsess over how busy they are. They obsess over what they own and how it is structured, and how much friction gets removed before compounding starts stacking. The paycheck funds the account, yes, but the account's design decides who gets harvested and who gets carried. And to be fair, this isn't about pretending one provider is trash and the other is magic. Fidelity's numbers are still strong. These are both solid funds, but solid is not the same as equal, especially when 6 figures are sitting inside a machine for 3 decades. When the underlying companies are nearly the same, every small edge becomes more revealing, because it shows you just how ruthless compounding is about details. The market doesn't care that 2 choices feel close. It only reflects what actually happened. So the real hierarchy isn't just investor versus non-investor. It is more uncomfortable than that. There are people who spend their lives converting labor into savings, and people who learn how to route those savings into efficient ownership structures. Both may look prudent. Both may call themselves long-term investors. But one keeps more of the future. And once you see that, you stop asking which one is good enough. You start asking where exactly the value is leaking, and who benefits when I ignore it, because that leak is rarely random. It accumulates in favor of the structure that compounds just a little cleaner, a little longer, with a little less drag. That is how people get systemically skimmed without ever feeling robbed. If you were staring at two funds that own almost the same market, but one path quietly left you with an extra $245,000 over time, would you still call that difference small? Or would you finally treat ownership like the real game? Here is the part most people skip, and it is exactly why they stay stuck. The wealth gap is not usually created by one dramatic move. It is created by one boring default that gets repeated for 30 years. In this case, the default is simple. If you don't want to be fully exposed to stocks, you need one mixed fund, one place, one rule, and no constant meddling. That is where balanced funds come in. They are not exciting. They are not cocktail party investments. They're a quiet split between growth and stability. Usually stocks doing the lifting and bonds taking some punch out of bad years. And if you get nervous every time the market drops, this matters more than your opinions about finance. Because panic has a cost, and that cost usually shows up after you sell at the wrong time. So the practical move here is not to build a sophisticated portfolio. It is much smaller. Open your retirement or brokerage account, look at what you already own, and ask, do I have more than one balanced fund doing the same job? If the answer is yes, stop adding new money to the extras today. Not next month, today. Pick one lane. That single action cuts off a surprisingly expensive habit, performance chasing through duplication. A lot of people think they are diversified because they own several funds, when in reality they just own several versions of the same idea, with different fees, different managers, and different opportunities to second-guess themselves. That is not a strategy. That is clutter wearing a suit. Now put the numbers back on the table, because this is where the clutter becomes costly. On paper, these two balanced options can look close enough to make the difference trivial. One fund holds roughly 60% US stocks and 40% bonds, and just keeps doing that, quietly, mechanically. The other uses active management, which sounds smarter, more responsive, maybe even safer to the average investor. But someone is making decisions and your money grows more are not the same sentence. Over a long horizon, tiny frictions stack up, fees stack up, timing errors stack up, human judgment stacks up. And then compounding starts amplifying those little leaks into a real financial wound. That is why the only useful behavior at this stage is mechanical behavior. If you're using a balanced fund, automate the contribution and stop touching it. Set an amount, pick a date. Let it buy whether the headlines are calm or ugly. If dividends are paid, leave reinvestment turned on. Don't create a side ritual where cash builds up because you're waiting for a better entry. That waiting habit is one of the cleanest ways to interrupt compounding without noticing. Money lands in the account, sits there, earns nothing meaningful. And you tell yourself you're being careful, but you're not being careful. You're inserting dead time into a system that only works when money stays deployed. And this is where the gap becomes impossible to ignore. Using the same $100,000 example, the long-run outcome is not a cute rounding error. One side compounds to about $3,380,159 over 30 years and throws off more than $16,000 a month in dividends by that point. The other lands around $1,740,570 and pays roughly $4,000 a month. Read that again slowly. Same starting pile of money, same broad goal, same category of fund. But the ending is not remotely the same. That difference is not just a spreadsheet curiosity. It is a different retirement, a different level of stress when bills arrive. It is a different answer to the question, can I stop working now? So when someone shrugs and says they're basically the same, what they're really saying is they haven't sat still long enough to understand what decades do to small disadvantages. This is why the move I want from you is intentionally boring. Today, choose one balanced fund for your do not touch bucket. Then, write a 6-word rule somewhere you will actually see it. One fund, auto buy, reinvest, no edits. put it in your Notes app, tape it near your desk. Add it as the name of your recurring transfer if you have to. The point is not motivation. The point is interruption. Every time you feel the itch to compare, tweak, swap, or react, that rule should get in the way of your impulse. Because most damage in personal finance doesn't come from ignorance anymore. It just comes from unnecessary action. If you want a picture of what this looks like in real life, imagine two investors on a Tuesday night. One logs in after dinner, sees red numbers, reads 3 comments, watches half a video, and wonders if he should rotate into something more defensive. The other investor doesn't do any of that. Her transfer already went through. Her dividend setting is already on. Her allocation is already chosen. She closes the app in under a minute. 30 years later, people call her disciplined. But most of what they're praising is not discipline. It is the removal of decision points. She made fewer opportunities to sabotage herself. That is the real use of a balanced fund when it is chosen well. Not magic, not prediction, friction reduction. A simpler portfolio creates fewer emotional decisions. And fewer emotional decisions usually mean fewer expensive mistakes. So, before you get pulled into the next shiny comparison, do the dull fix first. Clean up duplicates. Turn on automation. Reinvest the distributions. Then, leave the machine alone long enough for it to matter. And I'm curious about your own habit here. When your account drops, what is the first thing you feel tempted to do? Sell, pause contributions, or go hunting for a better fund? So here is the promise, and it is a different one than most finance videos make. This is not about finding the one perfect ticker and getting rich in some dramatic leap. It is about putting yourself in a position where a small edge, held long enough, does the heavy lifting while you stay alive financially the whole time. Yes, in this matchup, Vanguard comes out ahead overall. Yes, Fidelity still has real strengths, especially on fees and emerging markets. But the real win is not memorizing a winner. The real win is knowing you don't need to keep restarting every time the market gets uncomfortable, because that is where most long-term returns actually get destroyed. Not by choosing a bad index fund, but by panic selling after a red year, freezing contributions when the headlines get ugly, or jumping platforms because a cleaner app makes you feel more in control. The portfolio doesn't care about your excitement. It cares about time, consistency, reinvestment, and whether you can keep your hands off it. When your account balance looks sick to your stomach, that is the survival test. And if you fail that test, even the better fund can't save you. So, the practical takeaway is simple. If you value the strongest core fund outcome and want the cleanest case for long-term compounding, Vanguard has the edge in this comparison. If lower fees, account experience, or stronger emerging market exposure matters more in your real life, Fidelity is still a perfectly serious choice. What you shouldn't do is spend the next 6 months bouncing between both, opening tabs, comparing decimal points, and staying uninvested while your cash quietly does nothing. And that is the only kind of promise worth making here. Not that your $100,000 turns into a fantasy number on command. Not that $20 a week unlocks some secret income machine. But that disciplined structure gives you something more valuable than hype. It gives you staying power. It gives you options. So, if you were putting real money to work today, which matters more to you? The stronger core fund, long-term result, or the lower fee flexibility and emerging markets edge? Drop your answer in the comments and be specific about the account type and goal. Because that is where the smarter decision actually starts.